Something that I have found as a reoccurring theme conducting interviews on the show is that successful people always seem to be in the right place at the right time. Some of that could be attributed to luck, but more likely, it's that they're constantly looking for opportunities, and because of that, they're paying attention, and when opportunities present themselves, they take advantage of it. This is certainly the case for our guest today, who was able to identify a problem in the real estate marketplace, and when the time was right and the regulatory environment was changed, he created a VC-funded company to solve this very problem. Now, we're going to talk about a lot of topics today, but most importantly, it's about the business of providing debt for fix and flippers. This is a business that continues to thrive, and especially if you have a national view, there's always an opportunity to provide financing for people who are buying assets, rehabbing them, and selling them. So in this discussion today, we're going to talk about, first of all, how did our guest acquire VC funding for a deal he had in his mind? What was that process like? It's something that not a lot of people have been through. So there's always some insights into those experiences. Also, given the fact that our guest has a national view, he invests all over the country and provides loans for people that invest all over the country. So what are the markets that he's consistently seeing opportunities in, especially for the fix and flip business? Also, there's several markets in the US that are actually shrinking in population, but our guest talks about why that might be a little bit misleading. We'll discuss why that could be the case. Also, our guest has a lot of experience dealing with institutional investors as well as accredited investors. So I always want to get a good understanding of the difference there, and if there's any strategies that institutions are using that accredited investors might be able to implement for their own personal portfolios. If you're a subscriber to the show, you already know we recently went through a pretty significant rebrand where we changed the name of the investment company to ASIM Capital. But we are still keeping the name Cashflow Connections Real Estate Podcast, so that's staying the same. If you haven't already checked out the sites, make sure to do so. Go to cashflowconnections.com and check it out. You'll see the rebrand is complete there. It makes viewing the podcast much easier, listening to the podcast much easier. You can also subscribe in a variety of ways. This way you know that when we launch new content, you'll be the first to know. And if you go to asimcapital.com, you can subscribe there as well. That way, when we put out new investment opportunities, you'll get a notification and you'll be able to move forward with as little lag time as possible, which is important sometimes because some of our deals can be oversubscribed pretty quickly. So make sure to go to cashflowconnections.com, check out the new site, and of course, you can go to asimcapital.com, that's asymcapital.com, to get access to our investment opportunities. All right, thanks a lot. Hope you enjoyed the episode. How's it going, everyone? Our guest for today is Matt Rodak, who is the founder and CEO of Fund That Flip, which is a venture-backed online platform for real estate investing. Fund That Flip has actively funded several millions of dollars of transactions all across the U.S. in which they provide liquidity for borrowers, and investors who are the lenders in this transaction are able to invest in first position mortgages secured by single family homes that are being renovated. Investors can earn healthy returns with minimum investments as low as $5,000. So today we're talking all about fix and flip, but also just the business as a whole. So Matt, thanks again for coming on.
Yeah, thanks so much for having me, Hunter. Happy to be here.
Yeah, so obviously, leading a company that's had a lot of success over the last several years, really interested to get into this topic, especially since you guys have a national approach to investing, which puts you in a unique position. Before we get into all that, though, I'd really like to hear what the motivating factor was for founding the company. What did you see in the marketplace that you thought, wow, it's really a great opportunity to create an online platform, especially at a time when this wasn't terminology that was really commonly used?
Yeah. Great question. And I think for me, that my interest in real estate investing really happened at a relatively young age. I was 16 years old, and I think I've always had somewhat of an entrepreneurial bent and had a small landscaping business while I was in high school, and ended up, one of my commercial clients was a mortgage broker, and a lot of his loan officers had investment properties and were fixing and flipping properties. And I'd get called in with my landscaping company to help them, one, do the landscaping, but also occasionally do some demo work and some other kind of odd jobs. So got some exposure to this space at a young age and thought it was really neat how, value was being created in these otherwise distressed assets. Money was being made in most cases from the sponsors, and also thought it was cool how this ugly house who was really dragging down a neighborhood or a block, would be transformed into one of the nicer homes on the block and really, create value for that community and the other neighbors. So kind of thought, man, that's cool. I want to do that when I grow up. So sold the landscaping business, went off to college, studied finance, really a goal of getting into some type of real estate development post-graduation. Fortunately, or maybe unfortunately, I don't know what it is. I graduated college in 2007. right when, as we all know, the real estate market was starting to kind of collapse in on itself. So I ended up taking a job with a large commercial property insurance company and rose through the ranks pretty quickly to a point where I was running sales and marketing for a $900 million business. Got to do a lot of cool things and learn a lot from some really smart people. And I like to say it was kind of like my mini MBA. I think the biggest thing I learned in all of this was that I didn't want to be an insurance executive the rest of my life. Mm-hmm. So I started planning my exit strategy from corporate America and really getting back into my initial passion, which was real estate investing. So started buying some properties around the Providence area and getting involved in the community and doing some partnerships with some other folks that had more experience than I did and just really trying to learn the business. And through that experience, I learned of the lending side of the business. So the market that I was operating in at the time, banks weren't financing these things at all. There wasn't a lot of capital. There wasn't a lot of other, non-traditional, non-bank lending like there is today. So the lending, to borrow money was very a local exercise. So there was a guy in town who had, I think, $20 million at any given time kind of out on the street. He charged you 4 points and 14% interest. He had an 8-page loan application that you literally had to fill out by hand and fax. Yes, I said fax back into him. And then he'd get back to you in a day or two and be like, yeah, I don't really want to fund that loan because it's on this block and I don't really like that block. And it was always like, why did I need to fill out 8 pages of loan applications if all you needed was the address?
Right.
So it was just kind of a frustrating experience. I thought, the whole antiquated idea of hand filling out paper applications and faxing them. And, sometimes you'd call and he'd answer, sometimes he wouldn't, if he's on vacation. Like it was just very non-professional. And kind of while this was going on, I was also doing some personal investing on peer-to-peer lending sites. If the listeners are familiar, Lending Club and Prosper were the two big ones at the time. And kind of the idea was you could go and invest in consumer credit. So someone that needed to borrow money for a wedding or to consolidate credit card debt or whatever the case would be, you could build a portfolio. And I think the minimum investment was like $50. So I had a portfolio of these consumer loans. I mean, I was earning, after losses, somewhere between a 9 and 10%, return, and started scratching my head and saying why am I paying this guy 18% or more for my first position, mortgage loans that have 20% equity of my equity in front of them. And at the same time, only getting a 9 or 10% return on this unsecured consumer credit, which if, that borrower decides they don't want to pay me anymore, like that investment gets written down to zero. So just kind of saw this opportunity of, man, why can't we bring a peer-to-peer kind of model to this asset class, real estate, and at the same time, by bringing technology to bear, we can create just an overall better experience for our borrowers, lower the cost of capital, and if nothing else, just, create a better experience. So that was the idea. Fortunately for me, and one of the big things I've learned in having started this company is timing is as important as anything else. Kind of as I was, incubating this idea in my own mind, some other smart people were working on legislation in Congress to create an exemption to some of the securities laws that would allow us to raise money online without having to go through a lot of onerous process of registering with the SEC and FINRA and a number of other places. So that legislation is called the Jobs Act. It was a modification to Regulation D 506, which is now Regulation D 506C, which, without getting too far into the weeds, allows us to generally solicit the fact that we're raising money for our business, again, without the need to register with the SEC. So all of that happened. I thought, you know what, this is more interesting than flipping houses. So I packed my things up, moved down to New York City, and here we are 4.5, 5 years later, and it's turned out to have been a good decision.
Yeah, certainly. I actually want to hear more about that story, kind of the transition. So you came up with the idea, you did some research and maybe had some attorneys look into what the implications were of the 506C, which, by the way, I was in the business when that was kind of happening as well. And it was unclear as to how it was really going to impact the business as a whole, especially the world of syndications. Yep. But it was clear that, yes, it is going to be legal, but really the question was, are people going to care? Is anyone going to do this? Are people going to be interested in investing in real estate on an online platform? Yes, they can legally, but that doesn't mean it's going to be desirable. So once you kind of identified that legally you were in good standing, what was the next step? Walk us through how you were kind of quantifying whether or not there was interest and then raising capital for the business. Did you end up going to friends and family, or do you immediately go to VCs or et cetera?
Yeah, so I don't necessarily come from a network of super high net worth folks. So for me, it was a lot of building this network of potential investors somewhat organically. One of the theses that I had early on, and I think it turned out to be right, was that by focusing on this residential asset class, it's an asset class that most investors, whether or not they have experience investing in real estate previously, can understand, simply because they've probably purchased their own home before or owned their own home. So understanding the fundamentals of, buy a house for X, invest Y, sell for Z, right? There's a certain margin of profit in that transaction. And really, as an investor, the only thing I have to believe is, one, that property will sell for Z, and two, that the operator, the borrower, is qualified and experienced enough to execute against their plan. So, it's a very simple kind of fundamental exercise on loan to values and loan to cost ratios and a number of other things. And I think the same can't really be said for, and this is nothing to be disparaging against these other asset classes, but investing in an apartment building is like a lot more variables, right? Investing in an office building or a light industrial building, like you've got to understand leases and credit quality of tenants and, CapEx and OpEx. Like there's just so many other variables. And like for single family housing, like there's not as many, and it's just intuitively understood by most people. So, one of the theses was, let's stay super focused on this asset class. It will, one, I think, be easier to kind of get people to invest in. And secondly, will allow us to really focus on building a business that serves the needs of the specific borrower. And third, it allows us to build a lot of institutional intelligence and expertise around the asset class, which we believed would allow us to be better underwriters, be better managers of risk, and we think that's good, for our borrowers because it's higher levels of service, but also it's good for our investors in the sense that we're going really deep into one asset rather than kind of spread ourselves thin over a number of different assets.
Yeah, I agree. Completely agree with that. And it's one of those things with single family houses. Pretty much everyone in the United States, listening to this has a pretty immediate family member who's made some money in real estate. And it's almost always single family. Now they may have an uncle or something that's made some money in apartments or self-storage or something like that. But it's a little bit like that uncle that never listened to anyone, that kind of went about his own way. So I totally relate to that.
Yep.
So how quickly after you launched did you start to realize that there was a tremendous demand for the product and things were going to really, the positive trajectory seemed to be playing out as it was kind of in your mind?
Yeah. So for the investor side, like it wasn't really that hard of a jump for me to believe this would work, simply because people were investing, to the tune of hundreds of millions of dollars in consumer credit, which was, paying a lower interest rate.
That's a great point.
And had less security, right? So like, it was kind of like, this is a no-brainer, right? Even if people don't really understand it, if I can get in front of the people that are already investing in Lending Club and Prosper loans and say like, hey, one, better yield, and two, better collateral. We kind of believed like as long as we had a good asset and a good underwriter and could prove to them that we knew what we were doing on the origination side, like the money would kind of find its way to us. And that's largely what happened. We have a 42 employee company right now, and I've got one person on investor relations, right? So like the technology, the underwriting, the transparency that we provide on our website, we have third-party appraisals that people can download. Like all of that has built kind of a platform by which investors can intelligently make smart decisions that work for them without a lot of, I'll use the word selling, but a lot of hand-holding, if you will, on, helping them understand what they're investing in.
Yeah, and it's pretty remarkable to see that transition. And we recently made a pretty significant investment in a online portal, which really allows to automate that process. And you're starting to see, as people become more and more comfortable with investing in real estate, people be more comfortable with investing in real estate over the internet. That automation, that technology can be some of the best money you can possibly spend, because it's like having an assistant that works 24 hours a day that never makes a mistake. And so, to have only one person on investor relations with, I don't know how many investors you have, but many, 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 it's pretty remarkable to be able to create that system that just allows for the tremendous scalability, which I think all of us really like about real estate.
Yeah, it's kind of cool. Like I'll be, walking through Central Park with my wife and, pull up my phone and be like, oh, we've raised, $600,000 today, and like no one's working, it's like,
right.
It's kind of cool. It's a machine that's always on. And I think frankly, it also is good for investors because they can peruse these investments at their own leisure and hopefully get all of the information that they need from the system without needing to talk to anybody. And that's really what people want these days, right? Is the ability to self-service. So yeah, it is pretty cool. It still kind of is confounding to me of how much money we've raised on the internet from people that we'll largely never meet. But that's the era that we're currently living in, which is cool.
Certainly. Was there anything that happened as you were growing or experiencing that influx that made you frightened, or you're thinking, okay, the wheels are going to fall off, the investor experience is not going to be good? Or on the other end of it, where you're thinking, we may not make it to the end of this month if we don't close this deal or raise this capital? Just walk us through some of those potential horror stories that may have taken place over the last 10 years or so.
Yeah, I'd like to say they've stopped, but I think the thing that we've learned is, if you're tackling big problems and you're trying to do things that no one else has done before, there's not a playbook, right? And the thing that we've learned over the years is, one, mistakes are going to happen and things are going to happen that are out of your control. The way that we've approached those things is always just to run, head into them. And while we're doing that, over communicate to our investors, explain that we're, aware of what's happening, outline for them what our plan is to resolve it. And then at the end of the day, always do right by them. So, I'll give you an example that's happening this week to us. Like our banking partner, no fault of ours, our banking partner double withdrew investments from about 10 investors to the tune of about $680,000. So money got pulled out of people's bank's account twice on a single investment. Like that's a big problem, and it wasn't anything that we did wrong. It was, a partner that's been great for us and has, processed hundreds of thousands of transactions. So we found out about it. We, get those investors on the phone, explain what we're doing, explain what the process is, and explain to them that, we'll make them whole, and any overdraft fees or anything else that's caused, we'll make them whole. We'll pay them for the amount of time that their money is out and not working, at an interest rate that's commensurate with what's typically paid on our platform. Most people are understanding of that, right? And what they just want to know is that, one, you're taking care of it, two, that, you're willing to make it right, and, three, that you're not blaming others or shying away from it or pretending it's not a problem. If you're doing all of those things, for the most part, you can get through most of what is going to happen to you when you're building an airplane mid-flight.
Yeah, certainly. You have to be, at the end of the day, when things like that happen, it's really, what kind of person are you? What kind of person, what kind of culture do you want to have around you? We're in the process right now, as of the recording of this, of going through taxes, and it's really challenging. Obviously, just the structure of how we're positioned as a company, we have to receive the K-1s from the sponsors and then turn them around to investors. And even having a complete white glove relationship with a top tier CFO who acts as our in-house CFO, it's challenging. And there's always mistakes that are going to be made. It's just a matter of addressing those, communicating that you're doing the best you can, and also being able to execute when mistakes are made. So yeah, completely relate to that. So let's focus the conversation now on real estate, because like I mentioned in the intro, you have a national focus, which you have a really interesting perspective on the market because of that. And also, in my opinion, the debt side of things is always the first side to know, like, what's really going on in the marketplace, because they're the ones that get to decide whether or not people get their loans, which basically drives the ship, especially when it comes to real estate. So number one, there's obviously been a tremendous change in the marketplace since you originally started the company. Sounds like, 2012 or so, post Jobs Act. What are you seeing now that are some of the major changes in the business, and what are some of the things that maybe are being challenging right now, given the changes that have taken place back then?
Yeah, there's a lot of different directions I guess I could take this in. I think one of the biggest things that we've seen in our business and really in the market is, I'll call it greater efficiency in pricing of, this risk. So I mentioned, when I started borrowing money, I was paying 4 points and 14% interest. And, that's come down, over the years to 3 points and 13, 2 and 12, 2 and 11, so like we're down to, on average, I think, 2 and 9, 2 and 10, call it. So we've seen a lot of compression in pricing over the years, even in the face of, the recent increases in the Fed funds rate. So I think part of that is, you're seeing the market just operate more efficiently in terms of large national players like ourselves and others that have kind of, really, I think, helped facilitate a lot of the financing that's been needed. And secondly, there's just a huge appetite, not only nationally, but internationally, for yield. everybody's looking for yield and it's hard to find. So our product, I think, is particularly interesting for someone that's seeking yield because it's short duration, right? It's asset backed and it pays current every month. So I think that's been one of the biggest and most interesting things to kind of just see evolve from 2012 to present. And I think it's also a reflection probably of where we're at in the credit cycle. But that's been real. And that's something that, we've had to adjust our business model and our economics and also the types of investors that were investing in 2015 on our platform that were getting 12% returns. As good as those 12% returns were, they're also taking a lot of like startup risk, if you will, on, not just our platform, but, the real estate crowdfunding industry as a whole.
Yep.
Those guys have kind of like moved on and they're hunting for those 12 plus handles somewhere else. But we've had a new cohort of investors who are perfectly happy with 8s and 9s. And they're also in a better position from, investing now in a much more mature platform in a more mature industry that has a little bit less uncertainties around what's going to happen with all of this, So I think it's been just interesting, I think, to see how that's played out.
So do you allow international investors or it only is U.S. investors?
So it's a good question. You can be an international investor, but you have to invest through a U.S. based entity. So, okay. We do have international investors, but they primarily set up with Delaware LLCs or something similar and have U.S. bank accounts. And that's more a function of, I don't know how to legally sell a security in Spain or Brazil or elsewhere.
Right. So you issue the K1s to their EINs, which are LLC EINs,
that's right.
The United
That's
States.
Right.
Okay, cool. That makes sense. The same thing we do, by the way, just because it really limits. There's a lot of risks out there regarding securities, but other things as well that I think investors should be cognizant of.
Yep.
So looking at the market on a national basis, what are some of the markets in terms of geographic locations or cities, metropolitan areas that you're thinking and viewing as being really favorable, look really appealing right now?
Yeah, our business is, it's not rocket science. I mean, I think, where go the jobs, there go the people, and there's the need for the housing. So, a lot of the South, Southeast, Southwest, we're primarily kind of east of the Mississippi in terms of our geographic footprint. So,
okay,
we like markets in the Carolinas and in Florida and Georgia. And then again, a big market for us is also, the greater New York City area, New Jersey area, and that market's, shifting a bit in terms of, the dynamics around the price points given the tax changes and being able to write off property taxes and mortgage interest. So there's some changes. I mean, I think I like to give examples of markets maybe people don't think are good markets when they look at just the, kind of the data. And the example that I love to give is Pittsburgh. So I think Forbes just came out with like a kind of fastest growing real estate markets, and Pittsburgh was on the bad list because it's seeing a population decline. But if you actually dig deeper into the numbers, I think what's super interesting about a market like Pittsburgh and to some extent like Cleveland, Detroit, and Chicago is the population that they're losing are the older generation who's moving south and the lower wage earning kind of population that's also moving south to where the manufacturing type jobs are. And the types of people that are moving in there are, Pittsburgh's a great example of this, are high earning technology jobs. So Uber has a presence there, Google, Facebook. A lot of the tech companies are opening relatively big operations there to tap into the Carnegie Mellon, engineering program. So what that creates from a dynamic standpoint is a home that, an elderly person who, has been living on a pension and, is happy to sell their house for $40,000, $50,000, $60,000. An investor can come in and totally gut that thing, upgrade it, perhaps add some square footage, and now it's a $300,000 or $400,000 house for an engineer that's moving from San Francisco and thinks they're getting just this sweet deal on this 4-bedroom, 4-bath, a 10-minute bike ride from their Uber office. So, those kind of markets are super interesting to us, where we're seeing a shift in demographic. So the population may be going down, but underneath those numbers are a demographic shift, both on age as well as income, that we think creates a lot of opportunity for, investors to repurpose assets into, higher and better uses.
Yeah. And that's actually aligned with a lot of what I've been seeing as well. You mentioned Chicago in particular. I can tell that just by going there. That city is not struggling in the way that the demographics may paint the picture of when you look just on the surface. There's a lot of opportunity in that city. And, you're starting to see, quote, population decreases, but it's not really painting an accurate representation of what it's like to experience the city itself, to your point. So I really like that.
People in Chicago say, we're half Detroit and half like New York / kind of Silicon Valley. And the Detroit part of that city, I think, is seeing a little bit of a tougher time. But the other sectors of that economy, which is a very robust economy, are booming. And that's pushing, those other neighborhoods that maybe perhaps are more blue collar neighborhoods into, nicer places to live, because that's where people have to buy. And it's an interesting shift that's happening for sure.
So given that you guys are lending all over the country, walk us through your due diligence process, because I know that you have to, a significant amount of this is going to be done at a distance. And I'm interested to hear, as you get closer to funding, does someone need to go on site? And if not, how do you replicate that level of due diligence through technological solutions or otherwise?
Yeah. So, I think for us, it's with one, partnering with operators and sponsors that are experienced and capable in their market. So we're not a lender for the first time flipper or, someone that's watching the HGTV shows and think it's cool and wants to do it kind of as a side hustle. And there's nothing wrong with that. That's how I got started. But, we're really focused on the folks that are looking for a way to scale their business and need a reliable source of capital. What that does for us is it allows us to lean into their previous experience, the fact that, they have a proven track record on taking down projects, but almost more importantly is they're going to know the market better than we do, right? So we are underwriting our borrower to a pretty serious degree and putting a decent amount of faith in the fact that they know what they're doing. And then we, kind of to back that up, we want to make sure that they have some of their own capital at risk, right? So we require skin in the game. So our loan to values and loan to costs are always relatively conservative in the sense that like their money's lost before our money is lost. So they've got to put, money where their mouth is, if you will.
Do you mind give us kind of example of what those numbers look like in typical transaction in terms of loan to value, loan to cost, et cetera?
Yeah. So I'll use round numbers just to keep it simple. If it's a $100,000 purchase price, we'll finance up to, call it 80,000 of that, net of fees and everything else. So they're going to have 20K or 20% of the project ahead of us. And then we'll finance up to 100% of the renovation costs, but we manage those disbursements through a construction draw process. So work has to be done first, meaning the borrower has to advance the capital for installing the kitchens or replacing the roof or whatever the case may be. We'll send inspectors out, confirm the work has been done, and then we'll advance, back into that. Typically, when the project's finished, the borrower is still going to have 15 to 20% of the cost of the project. But by then, if we've underwritten it right, the value of that house has gone up, and we're typically at a, 35 to 45% equity cushion at our loan attachment point once, full value has been created and the house has been renovated, if you will.
Okay. And so in those markets, is a $100,000 loan kind of typical, or a $100,000 purchase price you mentioned, is that typical? And if so, what's like the highest end that you would consider, given that you're focused on the residential sector?
Yeah, so it's super market specific, and I think the way we think about it is, on a distribution curve, we want to be in the fat part of the distribution curve on whatever that market is. So, an example of this is in Greenwich, Connecticut. Like the fat part of that curve is like a $2.5 million house, right? Our loan values in Greenwich are going to be higher, but the outsell on that house in Greenwich is going to have the largest amount of buyers for that house are going to be the 2.5 to 4.5 million. So like, we want to make sure, whatever we're doing, in whatever market we're playing in, we're playing in the middle of that distribution curve. So that's Greenwich. In Pittsburgh, it's, an outsell of 350 to 450 or 500, right? And even, markets within Pittsburgh are very different. So across our book, I think our average loan size is like 260,000. We'll go as low as 100K, and we've gone up as high as 4 million. But it's really going to be market specific more so than it is, a general number, I guess, for our entire book.
Yeah. Totally makes sense. So you're significantly market dependent in terms of loan size, but you're willing, that's a pretty significant delta there in terms of the 260 to the 4 million, which I really like thinking about the distribution curve, because once you get outside of that curve, the volume starts to really decrease, the comps become less valuable. And then if something gets stuck, your buyer pool is small. And so you start to have a challenge with liquidity. And so that can be really challenging. But even with those numbers, you're still to a certain extent relying on the expertise of the operator. And the operator in this case is the fix and flipper. So given that that was the first thing that you said, when you're talking about your diligence, what are some of the items that you look for? Just give me a parameters of the typical borrower that you want to work with. You mentioned not first time. Do they have to be flipping multiple properties per month, multiple per year? What does that look like?
Yeah, so our kind of sweet spot borrower would be doing somewhere between 4 and 40 projects a year. And again, that's kind of a wide band, but generally 4 to 40. I think the way that we think about qualifying a borrower is kind of 3 buckets, right? So the first one is, how are they sourcing projects, right? So we want to understand that they've got a system in place to be buying right? Are they working with wholesalers? Are they sending out, postcards and finding things that are off market? Are they dealing with auctions? Are they getting pocket listings from brokers? Have they built an algorithm that knows how to find arbitrage on the MLS? Like whatever it is, like we want to understand that they have a real system for purchasing and purchasing right. And then we're going to want to understand, the story of each property in terms of like, why and how are you buying this at a presumably under market value price? The second piece we want to understand then is, how do you manage the execution of the rehab? Are you GCing the project yourself? Do you have a partner that does that? Do you have PMs that run around and do this for you? Do you have 3 different GCs that you work with? So this kind of gets into the execution risk. How are you managing the execution risk? And are we comfortable that there's not any single point of failure with your ability to actually get through the execution? And then the third piece is really around disposition, right? So what's your disposition strategy? Are you selling these? If you are selling these, who's your buyer? Right? We want to understand that the person actually understands their market and who's going to buy this house. Are they renting it and going to sell it as a turnkey investment property? Are they going to refinance it with a bank? Do they have a history of that? So those are kind of the 3 things that we really want to understand. And then, we have different methods for confirming those things, right? So if they've told us they've done 10 projects before and we're underwriting that experience, they should be able to show us 10 HUDs, right, of previously flipped projects. If they say they're using a qualified GC, great. Who is it? And can we see their license as a certified general contractor? We're asking all these things kind of at various points throughout the process, and then before we close the loan, confirming them. But yeah, it's certainly an important part of the process.
When you're looking at that, I really like that you mentioned the disposition as being one of the 3. Obviously, in the fix and the flip business, that's critical, but I think people don't give that enough credit in the world of syndications. Looking at the equity side of things, many of our investors are investing in deals and there may be a 7-year, a 10-year hold. During that hold period, usually about 50% of the return profile will be generated by cash flow and 50% will be generated by that IRR bump through gains from equity sales. Mm-hmm. And it's one of those things where you have to be an expert on the disposition side in order to get that additional 50%. So just being able to operate does not mean that you can buy right, doesn't mean that you can sell right. And when it comes to disposition in particular, it's really important that you have those relationships, right? Who are the lenders? Who are the brokers? Who are the potential sellers or buyers? And that actually, like I said, it can make a huge difference on the overall profile of the deal. Now, I want to transition. You mentioned GCs because this is where a lot of people get stuck. Especially you mentioned people that are watching TV shows about fix and flipping, and it's like, well, I can just go do that. They don't mention the headaches of the business are almost always about general contractors. Mm-hmm. So how do you mitigate this risk, especially since you are so far away from where the flip is taking place?
Yeah, again, right, we're leaning into the experience of the borrower, right? So presumably if they've had successful transactions previously, they've managed to develop working relationships either with general contractors or subcontractors that they're managing themselves. And like I said, we'd like to see as many kind of fallback plans as we possibly can there. I think the other thing that we think about, in terms of like worst case scenarios is, well, we are operating, nationally. We're pretty focused in a number of MSAs, in the different states, which means we do have some concentration of borrowers and, access to their resources. So if we get stuck in a deal in Chicago with a borrower who can't get something done with their contractor, we have the ability to call one of our other borrowers up and say, hey, do you want to take this thing over for us? Or do you have someone you can refer to us? So we are able to kind of lean into, the relationships that we've built in these markets, especially, where we have, higher penetration or we're working with a larger number of clients. So it's a real risk for sure. You're counting on a lot of other people to do what they say they're going to do. And you try to manage that the best you can with how you time your construction draws and getting lien waivers and a number of other things to protect yourself there. But I like to say there's a reason these loans are paying, 9, 10, 11, 12%. It's because there's some risk. And certainly this is one of those. But I think we do a pretty good job of managing it across the book.
I can tell from, just some conversations we've had previously and also from your bio that you've had conversations and also invested with and alongside and have investors invest in your business that are both accredited investors as well as really large institutional partners. The institutional partner thing is something that most of our listeners won't be as familiar with. Walk us through what it's like to work with institutional partners and if there's anything that we can take away from their due diligence process, which is obviously because they have much more economies of scale, they can spend much more time, they can be much more detail oriented. Are there any of those strategies that we can take away as accredited investors that implement when investing for our own personal portfolios?
That's a really good question. I think, from a fundamental perspective, like they're in a lot of ways looking at the same things that everyone else is looking at. I like to say like real estate isn't rocket science, right? There's only so many variables that you can really kind of look at and make a decision on whether or not you think you're getting compensated right for the risk that you're taking. So I don't know that there's a whole lot of like learnings around what they're doing that's, that much more intelligent than anybody else. I think what I can say is that, if you're investing on a platform like ours or others, having institutional investors participate alongside you is a very good thing because they are coming in and they're looking at our financials. They are coming in and looking at the underlying mortgage documents and making sure that there's actually an asset behind the note that we're selling to them. They're asking really hard questions around how we handle workouts and foreclosures and looking at our documented procedures and a number of other things. So it's something, one, that, we may not do for every individual accredited investor because it would just crush our business. And two, many individual accredited investors don't want to invest that amount of time into it. But I will say by having those guys, play alongside you, I think is something that is a positive. So some of our investors get annoyed. They're like, these guys are eating up all the capacity in the loans. And kind of our thing back is always, yeah, but they're doing a lot of due diligence on us and holding us accountable to doing certain things that we say we're doing, which is also good for you. So I think it kind of cuts both ways.
Yeah, I actually really like that answer. And that's one of the things that, we get asked all the time about fraud. And at the end of the day, if someone's going to commit fraud, there's not a lot you can do. However, it does feel really good to know that there is an institutional partner that went through the level of detail that you're kind of describing. So we have an investor that ended up investing $1 million with us. And because of that size of the investment, they had the capacity to do things like go on on-site visits with us all around the country, looking at the financials to a degree that most investors just simply do not have the time because it'll eat their returns, right? Because their time is valuable as well. And that's actually something that it never really occurred to me until relatively recently that that's actually a big mark in terms of a positive sign, positive data point. We're in due diligence right now with a workforce housing fund where there is a institutional partner that's investing $25 million. Well, what level of due diligence do you think they went through? It's completely above and beyond what most accredited investors have the capacity to do. So I definitely appreciate that as well. So I have two more questions. One is something that I really have been waiting to ask you given your position in the marketplace. So my fiance has a background in corporate events. She's very business savvy. She is really successful at the event space, but it's a really challenging business. She has to fly around a lot. If you are absolutely crushing it, the margins are just really not comparable to real estate. Pretty much nothing is. But basically, she sees what's possible in the business of fix and flipping. And I think there's a lot of skill crossover with the project management that she has with events and looking into managing the fix and flip of a property. Given that we have this tremendous market correction, especially in California, are you advising people that are considering getting into the business that this is not a good time to do so? Or is it the kind of thing where there's always a business to be had in the fix and flip business, and it's just a matter of focusing on a market that you understand and not necessarily relying on market conditions, but just being able to execute?
Yeah, I think it's the latter. I think, money can always be made in real estate. I think, what you have to understand is that the time horizon in which that money can be made may be extended depending on where we're at in the cycle, right? So I don't think now is any worse than it was in 2010. I think you just have to have a different strategy, and there is less margin for error because if you were buying in 2010, like it was only going to go up. We don't know if it's going to go up or down, but if you can build a business and have a strategy based on today's current market environment, like, yeah, like people have been making real estate in up and down markets. So I wouldn't discourage anyone to get into it just because it feels like we're at the top. Who knows, right? A lot of people can make a lot of cases for there's still a lot of room to run. The advice that I would give your fiance, if she would take it from me, would be I'm a big believer in hedging, right? So, before you quit your good events management job, to the extent you can, find somebody that's already doing this and help them out on the weekends, right? In whatever form or fashion, work for free. And I think this is my advice always to everyone that's trying to break into the business is you don't want to learn on your own dime, right? Like you want to learn on someone else's dime, and especially if, real money's at risk. So like take the time to learn as much as you can from others in real practical experience before you make that jump. And the other reason I like to give this is like she may find out she hates it, right? Like I flipped a couple houses thinking like that's what I wanted to do. Guess what? I hated it. Like I hated having to go look at 100 properties to be able to buy one. I hated picking out this color of granite versus that color. Like I just hated every aspect of it. I liked the idea of making the money and doing the deal. But like I didn't actually like the work, so like that's always my advice is there's always going to be an opportunity to get into this business. There's no need to rush into it. Find some people that can mentor you, find some people you can work for free, and kind of, tiptoe your way into it. And you'll know when the time is right, when you find the right deal, or find your right place in the market to leave the day job. But a lot of people put the cart in front of the horse and they get all excited about it. And they realize like it's going to take you 6 or 8 months just to find a property to buy.
Yep.
Why not do that while you're still pulling down a paycheck?
Totally. Man, I really appreciate that perspective. And that was actually kind of a segue into my next question. It sounds like you definitely answered part of it, which is, advice to young real estate entrepreneurs out there looking to supercharge their careers. And I think you really alluded to it regarding, finding someone that you look up to in the business that you want to emulate and kind of hedging. But if you had anything else you wanted to expand on that, I'd definitely be interested given the previous comment.
Yeah, I think something that I think a lot of people could benefit from is taking a longer term view on things. And I think this is hard for the fix and flip is like, I can make all this money in like 9 months. And no one sees, the 12 to 18 to 24 months that led up to that point of purchase, right? So like, I think if you're getting into the space and you're committed to it, you need to be thinking in like 10-year increments as opposed to like, week long or month long or even like year long increments. And that's kind of how I approach my business. Like Hunter, you and I don't have a whole lot of crossover in like our businesses today, but like I'm pretty confident in the next 10 years, like we'll do a deal together. Right. And like,
agreed. That's
cool. Like, right. Like I don't need to do a deal with you tomorrow or 2 or 3 years from now, but like we'll be in touch for the next decade at least and probably longer. And at some point, we'll have some overlap in interests or what we're doing. And like this relationship that we're, developing today will lead to that. Right. So I think that's, when you're getting started in the business, it's really hard to do because you want some momentum, you want some quick wins, you want to get paid, and all of that is fine. And you should be striving for that. But you should also, keep your eye on a further out goalpost, which is building a career in this business. And to do so successfully, you really have to invest in long-term relationships, which means there isn't an ask today or there isn't a give necessarily today as much as there is just listen and learn and, do what you can to help and be helpful to others and make sure you're building that orbit around you of people that, you think within the next 10 or 12 years, like these are the types of people, I want to be hanging out with.
Yeah, man, I echo that sentiment 100%. It's amazing what you can get if you go into a relationship trying to look for those types of people and the who, not how type of mentality, because it really does pay dividends over the 5-year, 10-year, 50-year, 60-year. I mean, you've seen that all over the business. So yeah, I really appreciate you sharing that. Before we jump off, let listeners know how they can learn more about you, your firm, and learn more about Fix and Flip.
Yeah, so the name of the company is again, Fund That Flip. You can find us at fundthatflip.com. Yeah, so encourage everyone to check that out. We have a lot of informational content there as well. We run a couple of podcasts and other blogs that we post on all things real estate investing. You can see some of the projects that are currently open for funding and that have been funded previously to get a sense of like what we do. I'm on LinkedIn, so just Matt Rodak. There's not a whole lot of us, Rodak. Find me there, or feel free to shoot me an email, Matt, M-A-T-T, at fundthatflip.com.
Awesome. We'll link to that in the show notes page. Matt, thanks again for coming on. Really appreciate it.
Awesome. This is great. Thanks so much, Hunter.
All right, listeners, thanks for checking out the episode. As always, the contact information for our guest will be available in the show notes page, which is hosted on SoundCloud, iTunes, and Stitcher. Don't forget, if you want access to some of the free goodies that I'm talking about at the beginning of these episodes, like free ebooks, weekly investor emails, and articles about some of the most important investment-related topics, make sure that you have created an account with CFC because this stuff is automatically available. You can do this by going to cashflowconnections.com and signing up as an accredited investor. Of course, if you have any questions, feel free to email me at hunterthompson@cashflowconnections.com. Thanks again.